So thanks everybody for joining us today. And we're excited to present the LPL Research Midyear Outlook 2020 with the updated views of the pillars for investing.
Adam, I'm going to interrupt you. I'm sorry. I don't see that it's recording. Oh, it is. Okay, never mind.
Yeah, we're good.
My fault.
Should be anyway, as far as I know.
We're good.
So we're going to look at the economy for bonds and stocks. As everyone knows, the headlines can change every day, and we'll be looking at these pillars and trail markers, if you want to call them that, in the mid-year outlook to help us provide perspective on facing the challenges now and preparing to move forward together. At the midpoint of 2020, we're mindful that it's an extremely challenging year so far in the United States and around the world, and we're in the midst of a pandemic that continues to impact all of us, our communities, and the economy. Together, we're looking ahead for new ways to face these challenges and how we can prepare now for better times. We've been impressed by what we've seen so far, the resiliency and accelerated innovation among large U.S. businesses, efforts by our national, state, and local governments to support the communities, and most of all, the dedication and unprecedented cooperation among our frontline health professionals, medical researchers, and everyday people to get us through the health crisis. All right, so everybody should have seen that we have a new slide, the economy, and we'll take a closer look here how the economy, the stock market, and the bond market all work together. And we'll take a look at the election for 2020 and discuss if stocks can predict the next president. Should be interesting. Let's begin with the economy. So much of the real-time economic data that we follow, such as transportation activity, home sales, jobless claims, are showing tangible evidence that economic activity, while it's still depressed, has started to make a comeback. The U.S. economy entered a recession in March of 2020, per the National Bureau of Economic Research, and that was as a result of the lockdowns and business closures to contain the COVID-19 pandemic. After GDP contracted by 5% during the first quarter of 2020 on an annualized basis, Bloomberg consensus expectations for the next quarter, the second quarter, are calling for a mind-boggling 34.5% contraction on an annualized basis, as the chart shows. We can see a strong second half of 2020 rebound in the economic growth as far as the economy opening up, and this recession may end up as one of the shortest ones we've had. So the resulting recovery is unlikely to be strong enough to get economic activity back to 2019. As you can see, it was pretty strong. And, it didn't move around a whole lot prior to 2020. So it's very possible that this won't be back to where it was for quite some time. The trajectory of the economic rebound remains uncertain, but based on the depth of the contraction and a multi-stage recovery, our GDP forecast calls for a sizable contraction in 2020, as you can see here. Second half growth headwinds may linger well into 2021, suggesting a swoosh-shaped recovery, or if you prefer, a check mark. And it's a quick, sharp decline, and then after a small snapback, a gradual recovery over 12 to 18 months. We believe that a square root symbol, which tends to have like a check mark, but then it levels off at the top, that we don't think that's it's a pessimistic viewpoint on there, because it implies that the flat phase of the recovery after the initial bounce, and also a U-shaped recovery, doesn't really capture the multiple stages that we think are going to show up. Our characterization assumes that a COVID-19 vaccine will not be widely available for another year or so. Verifiable progress on an earlier arrival could help sustain the momentum of the initial rebound and move the economy closer to a V-shaped recovery. Now, turning to the stock market. we've seen that stocks already are pricing in a steady economic recovery beyond 2020 that may be supported if we receive breakthrough treatments to the end of COVID-19. However, optimism we see reflected in the S&P 500 index now may limit the size of the gains over the rest of the year. So we've already come quite far, and that may seem to slow down a little bit. Our expectations for a gradual economic recovery in the second half of 2020 appear to be in conflict with the S&P 500's rapid ascent over the last 12 weeks, March to June. On one hand, the gains may appear appropriate based on the likelihood that the recession officially declared on June 8th may be the shortest ever, aided by the massive stimulus response that policymakers put towards the initial progress towards a vaccine. On the other hand, the risk of a second wave of COVID-19, or what we've seen lately, that there may be one massive wave, particularly in the southern and western states, have seen increases in infections and hospitalizations there. In addition to the 20 million jobs lost in March and April, reported by the US Department of Labor, it will take a while to come back due to social distancing constraints and the potential for lasting changes in the way people behave. The uncertainty around these paths suggests that stocks may have come too far too fast. And although some recessions have seen stocks quickly recover bear market losses like 1980 or 1990, most of the time the journey back to record highs have taken more than a year, as you can see here. If you look at the right side, you can see the months to recover. Some of those are short. There are also ones that have taken quite a while to come back. We have a question mark on the one we're currently in. But if we look at the left side of the chart, you can see the bear market duration column, how long we're actually below a 20% of a 52-week high in the market. This is definitely on one of the shortest. So that question mark, it really could go anywhere. So our S&P 500 earnings forecast for 2020 is $120 to $125 per share. And that is, the earnings per share is how they measure the profitability of all the companies in the S&P 500, so all the companies that have stock in that index. And at the midpoint, earnings would drop around 25%. You can see the very last column, which says February 20, and that would be down 25% from 2019's level of $163 per share, roughly in line with the average historical decline in recessions. So the average line, you can see, we're right about there at 26.5%. This forecast reflects, number one, the severity of the decline in economic activity that were in March and early April. Number two, the initial snapback in activity after many states started to reopen beginning in mid-April, and growth headwinds that will constrain the trajectory of the recovery later this year. So, while we acknowledge that we've come back quite a bit, there's still a lot of struggle ahead. So this is all has all of that factored in as far as what data is available right now. We believe the optimistic economic recovery scenario reflected currently in the stock market may limit the upside potential over the rest of the year. Our year-end target rate for the S&P 500 is between 3,250 and 3,300, based on a PE ratio of slightly below 20 and a normalized earnings figure of 165. Those numbers probably don't mean anything, but really, when you're looking at this, we're right in that 2020 base case right now. So just to give you a little bit of perspective, the bull case is if we think the stock market is going to do better. The bear case is if we think it's going to do worse. An annual earnings run rate like that may not be achievable well into 2021. But with interest rates so low and the possibility of a vaccine, we're comfortable using longer-term earnings targets to value stocks here. All right, now the bond market. So just like it says, modestly rising but depressed yields may leave investors with little return from bonds. We expect interest rates to remain at historically low levels. The Fed has, through its actions, have really brought down interest rates to the very bottom of the barrel, so to speak. We're right above zero. Our year-end base case forecast for the 10-year Treasury yield is 1 to 1.5%, which would be the lowest level to end a year on record if that comes true. Rising Treasury yields contribute to bond prices falling, which can be offset by credit spreads tightening and the interest income that most bonds provide. As this chart shows, with the credit spread for the Bloomberg Barclays Aggregate Bond Index, that's a mouthful, but it's just the bond aggregate index. It's the index of all bonds, so to speak. It's already near the average for the last cycle, and interest income is historically at low levels. We would expect the index's returns to be near flat over the rest of 2020 with some risk of losses. However, it would take a move above our target range to erase gains from the first half of the year. So if you can look over the long term, you can really see that the income from bonds has been going down over quite a long period of time. All right, the Fed is unlikely to hike or cut interest rates in 2020, so not a lot of change there, and maybe not even in 2021, even if the economic recovery is a little better than our baseline expectations as we show here. This is a poll of economists who believe there will be at least one rate hike in each year. So if you look at this, we are looking at a substantial number all the way in 2022. So, but even before then, you might have just a very small percentage of people believing that interest rates will move. So it's very likely that rates will stay low for quite a while. Persistently low inflation during the last expansion should minimize any concerns for the Fed that it needs to raise rates to keep inflation under control. Consistent with what it's been saying, we expect the Fed to remain accommodative for some time, and raising rates probably won't be on the table until after it ends its bond purchase program. That sometimes you may have heard that as quantitative easing. The Fed did not start raising rates in the last economic cycle until more than a year after its final round of buying bonds. All right, here we're at the election. Stock market gains versus recession and COVID-19. Although all election years feel different, 2020 is no doubt one of the most unique, I would say. We have a pandemic, a deep recession, and extremely heightened partisanship, mail-in ballot controversy, an unpredictable president, and the oldest presidential candidate ever. So there's a lot going on in 2020. We're often asked if stocks perform better under a Republican or Democratic president. So this may have been what some of you came here for when you saw election in the title. Really, there's no surefire way of saying what is going to happen either way. But the market does behave differently under different regimes, different combinations of lawmakers. And it also sometimes can help you get a better idea if the market thinks the election is going one way or the other. So, we don't really say that they perform best in any certain circumstance, but markets tend to like the fact that there are checks and balances and one party doesn't have too much sway. When Republicans controlled both chambers in Washington, on average, the S&P 500 gained 13.4% per year, and GDP grew 3% also. When Democrats have control of the House of Representatives and the Senate, the economy did a little bit better, with the GDP growing 3.3%, while the S&P 500 index was up 10.7 on average. And also when we've had a split Congress, however, the S&P 500 gain climbed to 17.2% on average, while the GDP growth averaged 2.8%. So again, that suggests that markets prefer the split power when it comes November. Again, that's just the law of averages. And stocks perform 3 months ahead of the election. That's usually a good figure to look at with the track record of deciding who might be in the White House come January. The S&P 500 is predicted that it has predicted every presidential election winner since 1984, and 87% of the winners since 1928. That's actually a pretty astounding figure there. With stocks favoring the incumbent party, if stocks are higher in the 3 months before the election, and as the chart shows, if stocks sell off or go down ahead of the election, the opposition party has tended to win and the incumbent party has lost. So it's just kind of a little indicator there. 3 months before the election, the market kind of either does well or maybe more poorly, and that might give us a little bit of a better idea what we could expect. So that's all we have today for slides, but we do have plenty of time for questions in case anybody wants to ask something that we covered, get a little bit more detail, or maybe expand on anything that we talked about at all. So these are just some disclosure pages that I am required to show you. So I'll just click through these real quick, and a lot of them are definitions of things that we might have talked about. All right, so do we have any questions? All right.
So of course, Adam, this is Brenda. Hi.
Sure. I can't see you waving, so I apologize.
It's of course the question is, so what do we do?
Okay. Well, I think the answer for us is a little bit of a complicated one, but we always try to be more proactive than reactive with the way that we deal with the stock and bond markets. So we are trying to see, what's on the horizon. What do we think is the best plan of action going forward? Because right now, in the last 3 or 4 months, in addition to that, the market has been a little chaotic. There was a large pullback, and then the market had a large rebound, and it's been a little choppy. So really, we want to look at things that we think are good long-term ideas, and we don't want to make any decisions without being very thoughtful. So really, we try to consider all angles. We try to consider what's ahead for not only the economy, but for the global economy, because everything is so connected now, and this pandemic is not just limited to the U.S. So really, we want to be really thoughtful and kind of keep the long-term game plan. Everyone that we work with, we really advocate for having a strong overall financial plan and sticking to that when times are tough and a little chaotic. That's really important.
Thank you.
You're welcome.
Anybody else with a question? So Adam, I was thinking.
I think Dolores is trying to say something. Let me see if I can unmute her. No, we're still not getting you, Dolores.
You're muted on your iPad, Dolores. Can you unmute your iPad? Dolores, I think you're looking at your computer. What about your iPad? Because it shows that that's what's muted right now.
Christina, did you have a comment? Maybe we can give Dolores a minute to try to figure out the mute issue.
Yeah, that page that you showed with the bond interest rates going down, I think that a lot of people might like to know, how does that correlate to what they're seeing with interest rates in their savings accounts and their fixed assets, because that kind of makes it feel more connected to what they're actually seeing. Yeah, that's the page.
Sure. Yeah. So when we talk about interest rates going down over time, you may have in the past, in the 80s or 90s, been able to go to a bank and get a CD that was paying double-digit returns, possibly, in interest. So really, if you looked any time within the last few years, that's definitely not the case now. You're looking at a percent of a percent. Really, you're looking at far under 1% for shorter-term CDs, and I think it affects the way that you're earning money when it comes to interest, but also what you're paying when it comes to debt. So you have the good and the bad. So when you go and maybe get a new car loan or get a mortgage, you can also expect a more reasonable interest rate. Maybe a 2% interest rate for a car loan. Some manufacturers are giving out really good incentives where you pay almost nothing for the interest. And mortgages, I believe, were just around 3%, they announced the other day, or maybe just below it,
Yep.
Which is pretty historic. So I would say that, you're paying less for the debt. Money is very cheap right now, but also you're not earning a lot for your interest-bearing instruments. So really some of the struggle that comes along with that is when you're trying to invest your money and you're trying to keep up with inflation, you might have to try a few different strategies that may have worked for you in the past, but now things are a little different. So you might have to figure out some other strategies there.
Thank you. And I think Dolores is unmuted.
Awesome. Did you have a question, Dolores?
I can see you. I can hear you. Can you hear me?
I can.
Well, I finally found the thing to unmute. And when there's something that comes up on my screen that says the host wants you to unmute or mute or whatever, right?
Okay.
So why does she want us to unmute when we're already unmuted? So I keep hitting the wrong button. I am just not computer illiterate, I guess they call it.
That's okay. Do you have a question for Adam about the presentation at all?
No, I don't. You guys are doing a good job. You just keep it up.
We
Thank
appreciate
you.
that. Thank you, Dolores. Anybody else? Jean, you're unmuted. Do you have a question?
Just wondered if there was anything that I should be alerted to make changes or just check with you ever so often.
You want to take that one, Christina?
Sure. So like Adam said, we are definitely keeping an eye on everything that's going on and making some changes. We're getting ready to do some trading come next month, but nothing that you need to do on your end other than, if you ever get nervous, give us a call. You don't have to wait for our annual meetings, semi-annual meetings, or anything like that. We are always here to talk with anybody that needs us to, or just explain what's going on. We've never, we started this off without explaining that we've never done a market outlook before because most people really aren't interested in the numbers of what's going on other than how it affects their personal accounts. But we thought with the strange year we're having, and we're going to go with that understatement, that it's a strange year, that it would be good to offer right now because everything does seem like it's kind of in flux. And we just want you to know that we are watching it. Not that anybody can predict what's going to happen, but we're sitting back and checking out where things are going. And, we have our conversations about where we want to be and how long we think something will happen or take to happen. So we're looking out at the next 6 to 12 months at this point. but the election is definitely going to be an interesting time period for us, without getting into, you know, politics. Carol, I think I saw your beautiful dog.
Yes, she was being really, really nice there for a while, but she got impatient and decided to come up and join me.
That's all right. We love guests. Bring anybody you want to.
Mm-hmm.
Good.
Yeah.
Any other questions? Did it answer, you know, so when you originally decided to join this webinar or Zoom meeting today, did anybody come in with a question that they wanted answered and, you know, this did not address it, or anything else that we can help you with? Any concerns that you have going on right now?
No, I'm all set.
Good.
Well, I always have concern about, you know, I've talked to Heidi about this a number of times. You know, you have savings account. Yes, you're not gaining anything or very little interest from your savings account, but you don't see it dipping drastically as you do your accounts that you have in the stock market when things go crazy. So it's always kind of difficult thing to watch.
It is. Carol, you know, it's, if you were here, I'd be able to show you. We have a book. Actually, I'm not sure if we still have it, Adam, maybe you know. But we have a book that shows what inflation does, how it erodes your money over time that you don't see. And the numbers on it are astronomical. I wish I could show it. It's so impactful. If I find that book, I'll send you a color copy so that way you can see the page I'm talking about, because it really gives you a great visual of something that you're not seeing happening in your savings account that's happening without us even knowing it. And over a certain number of years, how it just erodes the principal sitting in there. So
Yeah,
I will see if I can find that.
Yeah, because right now we are in a kind of a crazy time. It's because the country is not, as they show, the country, like right here in Georgia, we are undergoing a spike in COVID-19 cases, as you said, through the South. There in the Northeast, you work pretty hard to bring it under control. But I also saw that some states are starting to drift backwards again. So we kind of on a roller coaster. The whole country is not on an even plane. So it's hard to predict what's going to happen, you know, across the board. And when the vaccine does come out, I'm not sure how many people are going to line up to take it, number one, until you find out really what's going on with it and how effective it will be. So I don't know if we should wait around to try to decide, you know, to get a vaccine before and not do anything in between. Anyway, it's just a very unpredictable time. And there's nothing that really, I guess, like you said, just kind of watch things and see how they're going. But I do see things probably going down again before they come back up.
I think, go ahead, Adam.
Oh, I was basically going to agree with you, Carol, that I do think that, you know, it's going to continue to be choppy. And that was the reasoning behind using more of a swoosh. And, you know, the end is probably going to be really squiggly, I would say. We're not going to see a straight line on the end of a square root mark. You know, that's the nature of the market, that the fact that it goes up, it goes down. And actually, the more volatility usually presents the most opportunity in different cases. So, you know, if we took a static look at investments and we said, okay, this is our investment that we have for the next 10 years, I think that we would feel very differently. We would probably operate completely differently in that manner. But the fact that everything moves around and there are different things that we can look at all the time really keeps me optimistic that there are definitely areas of the market that are doing well. There are some that are not doing very well at all. But being able to use the data that we have on hand to make some good decisions and be really thoughtful, you know, I think that's the big thing that you have to look at is, you know, over the long term, making the best decisions that you can and really trying to work on having different things at your disposal. So maybe you have some cash on the side, maybe you have some income in retirement, maybe you have a few different buckets of investments, and keeping balance throughout everything can really help get through the tricky times in the market.
Yeah, and that can be true for any time period, even outside of a pandemic. We will go through this again. That's the long and short of it, is that we will hit these recessions every few years. And Carol, I know with your background that I definitely am listening to you wondering if we should be taking the vaccine right away or waiting. So
Yeah, well, we'll see.
yeah.
But yeah, I was around in in 08. I remember that, and so yeah, you do have your ups and downs.
Well, in that one slide that Adam had showed, I think it was 49 months to recover from 08.
Yeah, it was a while. Yeah.
Yeah, I mean, that's 4 years, right? Sorry, Adam, to make you go through your
You're fine. I'm just trying to make sure I go the right way.
So yeah, 49 months, that's pretty significant. And so it would seem that with us recovering so quickly from February, maybe we have to go back down in order to even out to the average a little bit more here. Who knows? We'll wait and see. We can't even know until, January 1st of 2021 how this all turns out.
Yes, it's always very easy to see looking backwards, like, oh yeah, of course, that was the bomb.
Perfect vision at that point.
But that you really can't tell until you're through it. But I think part of the issue right now is that people are looking at past recoveries and trying to say, okay, where are we at compared to back then? And we do have to, at a certain point, realize that every time period is different. The set of circumstances that we're in now is very unique to our situation now. It's not a crisis like there was in 2008. Most of the economic damage that was caused is self-inflicted. The government in different states and partly the federal government had partial shutdowns. There was quarantine. You know what I mean? There's a lot of things that happened that had to be done, and it wasn't caused by excesses in the market or bubbles, anything like that. So this is definitely going to be different. So we can't say, there was a big surge back in 2008, and then it went back down, and then it went up and then it went down. This could be completely different. So we just have to work with the data that we have.
Yep, and it is every time. Brenda, did you have a question?
Yeah, I was thinking when you were responding to Carol's questions, does that mean we should anticipate that our dispersals from the IRAs will be going down to nothing?
So the required minimum distributions for 2020 have been waived. You are not required to take anything out, even if you're over the age of 72. And just as a quick reminder, it changed from 70 and a half to 72. So you are not required to take any money out this year. And as far as next year, it will be based on your December 31st, 2020 value of your account. So depending on where your account goes from now until then, if it stays flat, then it'll be about the same as last year. If it goes up, then it could be slightly higher than last year's. And if it goes significantly down, then it could be less than last year. So it's hard to know until, again, like I said, on January 1st, 2021, I can tell you a lot of what happened in 2020. It makes it a little bit easier, but we won't know until after that December 31st value happens.
Mm-hmm.
Okay, thank you.
Yeah, sorry. I wish I could give you something more concrete than that, Brenda.
And also sometimes it's hard to know because the government will pass, certain legislation that actually is retroactive. So when we look at certain things like this year, the 2020 required minimum distribution was waived for the year, and there were definitely people, I'm sure, around the country that had already taken their distributions early in the year to get it out of the way. They made that after the fact. So it's very common. A lot of the times you'll see legislation that comes at the very end of the year, and according to the law that passes, it was in effect for the whole year, even though it's 2 days before the end of the year. So it really is kind of a wild card for that going forward. We'll see what happens.
Yeah, and they did the same thing in 2008, 2009. I can't remember which year it was, but they had waived them that year as well.
Oh, no.
So every once in a while, we get that little bit of a surprise.
I have a question. That's my question. Have they done it before? Have they done anything to try to make up for the difference? Requiring you take out more the next years or something like that to make up for that year that was lost?
No. Their thinking behind waiving the required minimum distributions in years where the stock market might take, or your accounts might take a significant decrease, or might have a significant decrease, is to allow the money to stay in there to hopefully grow. I mean, of course, there's no guarantee with that, but they don't turn around and then try to penalize you by having you take out more the following year. The formula for the required minimum distribution stays exactly the same from year to year. They can just determine if they want to waive it for specific years.
Mm-hmm.
And that's always based on the December 31st value and your age.
Yep.
And then it's just a nice little math equation. Any other questions?
All right. Well, this was our first stab at doing something with the Outlook and giving you guys kind of a market and economic update. So let us know if you thought this was useful, and maybe we can do something similar in the future. But thank you very much for attending the Zoom meeting today, and we really appreciate seeing all of you.
Thank you, Adam.
All right.
Thank you, Adam and Christina. This was very useful.
Great.
Bye.
Great.
Bye.
Bye.
Bye, everybody.
Go on.
Bye.